Hello, I'm Finola Burke from RaaS Research Group, and today we're speaking with Dimitri Courtelis, the Group Chief Financial Officer for Ricegrowers, which trades as SunRice Group, ASX ticker SGLLV, following the company's FY25 results. Welcome back, Dimitri, and thanks for joining me.
Thanks, Finola. Always good to chat.
The SunRice has delivered a strong FY25 result with a 3% uplift in EBITDA to 147.7 million and an 8% increase in profit attributable to B-class shareholders on the back of a small 2% decline in revenue to 1.85 billion. Now, in recent years, SunRice has made a significant push into branded product. Are we seeing the benefit of this move in your results?
Yes, good question. So particularly at the top line, you can see that that leveling out compared to the prior year. But when you actually look at the quality of the results, we're quite pleased that the accretion at the bottom line continues to grow. The push into branded products is really the place that we're trying to play in, and it really talks to the 2030 strategy. So approximately 70% of our group sales at the moment are in branded positions, and that balance of 30% is generally in your tender markets, whether it's trading into the likes of the Korea or the Japanese tender markets. Those bulk trades are high volume and help revenue, but they don't do much at the bottom line. So over time, converting those into your more accretive branded plays will help improve certainly the bottom line as we try to chase that double-digit EBITDA percentage as we in the lead up to the 2030 strategy in particular, but then also replace that top line with, again, more quality revenue. So that step change in the branded space is exactly what we're trying to do, have been trying to do, and certainly continue to flex further. So a lot of innovation expected to come through the pipeline, and that'll help deliver that outcome as well.
Well, we did see some very strong margin expansion in a couple of the core divisions. Yeah, Rice Foods was up 250 basis points, and I think CopRice was up 280 basis points. Can we expect to see that similar sorts of leaps over the next couple of years?
Yeah, if we break those two down a little bit. So CopRice, again, moving away from the historical ruminant stock feed positions, which is still an important part of the business, but the drive to the more innovative branded sales in the equine space and the companion animal space is really where we're trying to flex that business. That's evident with the most recent acquisitions of Pride's Easy Feeds in the equine business, which we picked up a few years ago, and more recently SaverLife in the animal nutrition business, particularly the dog food space. So that was in August of 2024. So going forward, we'll obviously lap 12 months of earnings in that position within CopRice. And that step change away from the ruminant side of the business, as I mentioned. So we're no longer looking to push the stock feed side, which is important to help lap up the utilization and the efficiency in our mills. However, the seasonality and the impacts of drought historically have played into that segment as well, which is exactly why we've tried to reposition that into the more branded companion animal space. So it's more that animal nutrition strategy from a branded position going forward that we would continue to look at. And again, talks to the strategy of growing the bottom line with healthy accretive margins and over time improving the top line as well. And then to your other question on Rice Foods Group, to knock that one off, equally, a lot of innovation that's come through the pipeline. Microwave rice, we've also launched protein chips, which has been a very popular product. And that innovation is what we expect to continue driving. So the whole messaging is really around brands and pushing the value add in particular. There is obviously competition from private label if you're just looking at normal bags of rice. And that's why we're looking to reinvent the category and really come up with some innovative products, both globally, locally and globally as well. So over time, look to improve that portfolio offering and continue with the brand resonance that we have both in Australia and in our international markets.
And Dimitri, you've provided FY26 outlook that you expect to build on the FY25 results from both a revenue and NPAT perspective. What are the key positive drivers behind your outlook, and where could this be challenged?
So on the positive side, continue to grow in the segments that we've spoken about already, and we expect CopRice to continue to delivering, the Rice Food Group to continue to delivering. We also had that strategic capex that we announced last year of upgrading the packing hall in our Leeton facility. So that will improve efficiencies and productivity, which will help the paddy price. But then over time, as that improves the asset base, we'll also get that upside on the asset finance charge in due course. And equally on the other side of the business internationally, our Middle East market is growing strongly. Despite the challenges that are occurring at the moment, we have been in market for close to 30 or 40 years, a very strong brand. And in the market, the products certainly fly off the shelf, which is good for consumers, and it's a brand that they trust. So despite the regional conflicts, we expect our Middle East positions to continue to grow. On the headwind side of the equation, again, we're in a pretty volatile place at the moment globally. So supply chain is one that we're watching very closely. If, for example, the Red Sea Suez Canal were to close again, that caused a bit of disruption last year as we had to reroute boxes around Africa. But that's open at the moment and continues to appear so for the foreseeable future. So that's one we watch closely. The Panama Canal, again, on the other side, is also causing a bit of headache because they were experiencing some challenges due to droughts, and the water level wasn't able to let larger ships go through. So subject to those types of supply chain disruptions, and again, because we supply and have source of supply around the world, 12, 13 different opportunities that we're able to flex at pretty much any given time to sell into the over 50 markets that we have globally. It is a complex matrix of supply and demand, but it's one that we've been able to navigate quite well over the last few years, and we'll continue to ensure that the robustness of that supply chain remains intact. And then, of course, it's the FX challenges with the Australian depreciation against the euro in particular, as well as the USD, which causes a bit of angst and pain for the import businesses like Riviana. And then, of course, you've got Papua New Guinea Kina, which is also depreciated against the USD. And the Pacific market is one that's macroeconomically challenged with the affordability. So we do have a lot of positives that we continue to work on, but equally, we also have the headwinds that we're working through. It's a relatively complex business model, but no different to the environment we've been navigating through in the last number of years. So again, the resiliency of the business model hopefully coming through, and we hope to grow from strength to strength with everything that we're working on.
And Dimitri, have you had any impact from the US tariffs, for example, or have you seen any impact from the recent escalation in the Middle East?
So not directly from a US tariff perspective. We don't import products or nothing material into the US. Our US position is a vertically integrated mill where we procure paddy locally in California, and that goes through our milling operations in Sun Foods in Sacramento in California, and we sell that product domestically in the US, and then also internationally through some of the tenders that we touched on earlier. So it's not so much an inbound market for us from an exposure to tariff perspective. It's more a domestic market in the US and export as well. I'd say more globally, the indirect tariff noise is one that we're watching, and that's playing directly into the supply chain challenges and as trade flows are disrupted, and also into FX. So FX is probably the biggest indirect impact or challenge rather from the tariffs, and already calling out the exposure to the euro and the USD as we import into Australia.
And SunRice has reintroduced its DRP for shareholders. They also have a very nice dividend with a nice dividend yield of 6%, even though the share price has appreciated nicely over the last 12 months. What sort of take-up are you anticipating, and what's the thinking behind the reintroduction?
Yeah, well, firstly, on the dividend, the board has been very cognizant to ensure that we are rewarding the B-class investor, and they've had the ability to flex the payout ratio over the last few years to ensure that message comes across. So the consistent and the strong dividend is one that is always top of mind at the board. And in terms of switching back on the DRP, again, we felt it was an opportunity for shareholders to reinvest in the company and help support our growth. Our capital management strategy and plans, particularly the Leeton CapEx upgrade that we spoke about already. We announced that last year. We have another CapEx upgrade that we're looking to commission over the next 12 to 18 months in our rice food business as well. So we'll look to cycle that funding through the capital management and help to support the strategy going forward. We continue to have a strong balance sheet. The liquidity also indirectly in our shares are improving. So with the Agri Index last year, we made that in, I think it was November, and then hopefully the ASX 300 in due course. So that capital management element is really one that we're focusing on, and it's all around delivering against our 2030 plans.
And Dimitri, you as you mentioned before, you have got investment plans for FY26. What sort of benefit returns do you expect from those investments, and what's the sort of the payback time that you expect for that?
Sure. So it certainly depends on the investment horizon, the type of capex that we're looking to introduce, and we generally split our capex between what's operational in nature or repurposing safety capex and making sure we're upgrading our existing positions. But there's been a big focus in the last few years and continues to be the case going forward in strategic capex, as we really look to improve the margins of the products that we're manufacturing, and then also look to build scale. So the improvements of ROCE versus WACC is a metric that we watch very, very closely to ensure that we're delivering for our shareholders and creating value as a group, and also driving economic profit when you consider that WACC against our capital employed. So fundamentally, it's really balancing our strategic capex with what we need to do from a more day-to-day capex perspective. But the last year was a good example where depreciation was around the $30 million mark. We invested over 42 million in capex, and the balance was really in the strategic capex space. And we expect to have a similar profile of capex next year, and that's been called out in our outlook with regards to the upgrade in the rice food business. So again, the capex from a strategic perspective continues to be a focal point of us going forward. And to deliver the strategy, we will need a combination of whether it's strategic capex enabling some of that growth, obviously organic growth as well, and then complemented by M&A as well. So bringing that all together in light of that 2030 plan.
And does that upgrade allow you to produce even more branded product through the rice food business?
Yes, so it's certainly enabling us to remain agile in terms of product development and innovation, following consumer trends, and that's obviously absolutely key. As I mentioned previously, a bit of pressure from private label. So it's a constant reminder that you have to reinvent yourself and make sure the innovative pipeline is full, and we can continue to deliver new products and introduce them into the market. So the expansion plans do give us that opportunity to introduce further lines of business and expand on existing lines as well, but then also be able to adapt to new product preferences that may pop up over the horizon, and ones that we can manufacture locally and keep that scalable opportunities in our operations as well.
Well, thank you, Dimitri, for joining me today to discuss the company's FY25 results and the outlook for FY26. Looking forward to catching up with you over the course of the next 12 months to check on SunRice's progress.
Thank you, Finola.